Let us now look at the risk profile associated with the long-term liabilities. So long-term liabilities can be of different types anyways, but there can be different risks attached to it. On the x-axis we have represented the risk to investors, and on the left hand side this is basically the return that the asset or the security may require from its investment. So when it comes to the short-term government bonds, you can see that the return required is minimal because the risk associated to this is minimal. These are short-term sovereign bonds backed by the government, and definitely there would not be any risk related to the default. Now the second, which is immediately above the short-term government bond, is the senior secured credit facility. See, the credit facility is provided by the bank for the revolving working capital kind of loans, and these are again secured by different kinds of assets. So this is considered to be the most safest over and above the short-term government bonds. Then next in line is the senior secured mortgage note. So these are not related to the credit facility, and these have slightly higher risk than compared to the senior secured credit facility. Next comes the senior unsecured notes. So unsecured notes are not backed by any collateral or mortgage, but because of the seniority here, it is less in risk as compared to the subordinate note. So after the subordinate note, then comes the equity class, which are divided into two types: the preferred stocks and the common stocks. So preferred stocks have the preference over the common stock in terms of dividends and in case of liquidation. So they come ahead of the common stock, and the common stock shareholders are the last ones, and they are the most riskiest class. So you must have heard about various kinds of rating agencies like Moody's or Standard and Poor's or Fitch, and these rating agencies basically try to see whether the bond is good or bad from the investment point of view. So here is a list of the ratings that these agencies provide to different bonds. Primarily classified into two types: investment grade and non-investment grade. So rating related to A could be considered an investment grade, a non-investment grade could be C and below. So various companies raise money through bonds, and that are rated by these agencies. So let us take some of the examples from the market and see how they were rated. Please note that these are some old returns which have been shown in our slides. However, this is only for the reference purpose. So let's take an example of General Electric. They've been rated as AAA, and the return expectation is pretty low for this one, 4.73%. So let's go to the bottom of the pyramid and see J. Crew. This has been rated as CCC, and the return expectation is 9.85%. So the return expectation is quite different for investment grade and non-investment grade. Reason being that non-investment grade are considered to be risky ones, and if there is high risk, definitely we would look at higher returns from that investments. If there is a lower risk, lower returns are expected. McDonald's, a less risky one, has a return expectation of 5.62%.